Good evening, ladies and gentlemen. Those of you who have signed on to this webinar, my face must be familiar to all of you. My name is P.C. Narayan. I'm the course instructor for this course titled Equity, Stock Markets, Concepts, Instruments, Risks and Derivatives. May I take this opportunity to introduce some of the people who have been working with me in producing this course and delivering it on the edX platform. This is coming up. Navneet. This is Ranjita Shastri. She's been working very hard on this and the other courses that I've delivered on the internet. This is Navneet, who's the person behind the camera, and Sandeep, who's also the other person behind the camera, who's actually making sure that it reaches all of you. So thanks very much, guys, for coming along. Just give me a moment. What we've done in terms of a structure is to take all the questions that you posted on the discussion board, and I've tried to expand on it. So we have a fairly continuing narrative which will add to whatever you would have learned by watching the videos. And I'm acknowledging the names of the people who have asked that question. Samiran Adhikari had a whole host of questions. He had a whole host of questions, so I'm going to take them up in one lot. His questions were, are stock exchanges a profit-seeking private entity or a highly regulated state entity? How does a stock exchange make money if the ultimate aim of the stock exchange is making money? Are all exchanges in the world private, or if any stock exchange wants to become public, where will it be listed? If exchanges are all private, then how or what authority a regulator has to make sure exchange operations are respecting the law of the land? It's a very fine set of questions, so let me give you the answers, and here we go. Stock exchanges could be owned by a group of entities, or it could be a listed entity. For example, and I've given you a web link right here, this is the NASDAQ. The NASDAQ stock market is owned and operated by NASDAQ Incorporated in the United States. The stocks of NASDAQ Inc. are listed on its own securities exchange. That means NASDAQ Inc. is listed in NASDAQ under the ticker symbol NDAQ, and NASDAQ INC is also listed in some of the other exchanges. So here's a case of a stock exchange being publicly listed. The next one in that list is the National Stock Exchange in India, or NSE for short. NSE is owned by a set of leading financial institutions located in India, as well as banks, insurance companies and other financial intermediaries, and it is managed by professionals who do not directly or indirectly trade on that exchange. So that's a different type of ownership. NASDAQ was owned, the NASDAQ Stock Exchange is owned by NASDAQ Inc., and NASDAQ Inc. is listed, Inc. as in INC, Incorporated, and that in turn is listed in the NASDAQ Stock Exchange and other stock exchanges. The National Stock Exchange in India, which is based in Mumbai, on the other hand, is owned by financial institutions, banks, insurance companies, and so on. It's not listed, but is run by a group of professionals who are not allowed to trade in that exchange. Then you have, I've taken an example of another stock exchange which is based in India, which is called the Bombay Stock Exchange, which is the BSE. And BSE has a very interesting ownership. Now, if you put the clock back to about 30, 40, 50 years ago, when stock exchanges were not as powerful and not anywhere near as large as they are today, they were essentially mutual institutions. By mutual, we mean the brokers who were licensed to sell and buy in the exchange were the owners of the exchange. So that's what we call a mutual entity. the brokers were the owners of that exchange. Now, 30, 40 years ago, that was the architecture of the Bombay Stock Exchange, BSE. But as time went by, that model was getting difficult to sustain, given that the exchanges have grown exponentially in terms of their volumes and value of trade done, and therefore Bombay Stock Exchange now has a very interesting ownership. So here we go, that's the ownership of the Bombay Stock Exchange. The exchange is owned by many different financial entities. Although the percentage keeps changing based on transactions, I can give you the latest details of the top 10 shareholders as of financial year 2016. The top 10 shareholders of the Bombay Stock Exchange. And if you look at it closely, it's the Deutsche Börse, the Singapore Exchange, the State Bank of India, Life Insurance Corporation, and a few other entities. There is an upper limit of how much one entity can own in a stock exchange, and hence the ownership is so divided. For your information, world famous investor George Soros owns 3.74% of the Bombay Stock Exchange via one of his entities called Quantum. He has bought a stake of 4 to 5% during 2011. A lot of old Indian stockbrokers are also owners of that exchange. So I've just given you 3 models of how a stock exchange ownership is composed. Publicly listed, owned by entities which are in the financial domain, and 3, owned by brokers and by other exchanges, multinational entities. Right. So I hope that tells you how different the exchange ownership of equity stock exchanges happen. Not just equity stock exchanges, commodity exchanges, foreign exchange, exchanges that deal in foreign exchange and derivatives, all of them have a similar structure and composition. They are not identical from one exchange to the other. And stock exchanges worldwide, irrespective of their ownership structure, are regulated, and this is the other answer to Samiran's question, are regulated by the security market regulator in its country of domicile. For example, the Securities and Exchange Commission in the United States has regulatory oversight on all of the exchanges in that country. Equivalent of the SEC in India, for example, is the Securities and Exchange Board of India, which actually has a regulatory oversight over all the exchanges that exist in this country. There is a similar securities regulator in every country around the world which boasts of exchanges where large volume buy-sell activities on financial instruments happen. Now there's this other question. It's a long one. I split it up into parts. Money is constantly flowing from one asset class to another asset class. Can we discuss the predictors / relationship for such a trend reversal? So that is the first question. Interestingly, this has a lot to do with the stage of economic development of that country. What do I mean by that? If you put the clock back 40, 50, 60 years ago, or maybe more in some countries, go and ask your grandparents, your great-grandparents, if they are still alive. Where did they put their savings? There were no equity stock markets, there wasn't a debt market. All of these are born in the last 60, 70 years. In fact, in some countries, born only 20, 30 years ago. So where did they go to save? They saved in the form of gold, because those of you who are familiar with international finance know that there was something called the gold standard. All currencies were linked to gold. So there wasn't an exchange rate, for example, between the US dollar and the euro. Everything was denominated with respect to gold. That's the era of the gold standard. So people saved, that means all the money that they had, their only form of savings was to put it in gold. And because of the high demand for gold, gold was always appreciating, and therefore their wealth kept growing as long as gold prices were appreciating. But remember, gold is a commodity. and there were other sophisticated markets that came along as the world moved on. The next was real estate, which again is an asset class. Gold is an asset class, real estate is an asset class. And a lot of people in the middle of the previous century, and more recently in some of the emerging economies, their investment was first in gold and or in real estate. You bought yourself a home, maybe 2 homes, because it is considered an asset class that is going to continue to appreciate. The logic being the amount of land in any country is finite, and therefore the price of land has to go up as more and more people start buying real estate. That faded off as well as time went by, because real estate prices, as you know, are very speculative, and there came a point when the prices just tipped over, and instead of rising, the asset class had a fall in the value, and people were disillusioned. The next asset class they looked at was equities. Now the great thing about equities, if you buy into the equity of a company that is performing well, and obviously you wouldn't want to go and buy equity stocks of a company that is not doing well, you will find that it's an appreciating asset. In other words, every year the company makes profits, it's plowed back as retained earnings, the book value of the company or the net worth of the company goes up, and when the net worth goes up, the equity stock price also goes up. So for well-performing companies, which probably started with a share price book value of say $1, is probably trading at $100, $120, 30, 40 years on. So well-performing companies, equity stock prices is always appreciating. Now we will see more of this as we move forward in this webinar, but important to note, when equity stocks came as an asset class, a lot of people moved into that asset class because they could understand the risks, or they are expected to understand the risks, and invest only in those stocks which would have a history of appreciating equity stock prices. So today if you look at most people, they would have some investments in real estate, some investment in equity stocks, and for liquidity reasons another asset class is cash. Not cash as in physical cash, but some money in the bank. So if you suddenly need money, you go to your bank, but that's usually a very small component of your total assets. In other words, where is the economy placed decides what are the asset classes that the people of that country invest in. Even to this day, and I don't want to mention names of countries, there are some countries which don't have an equity stock market. So if you're a citizen of that country, you're making a lot of money buying in real estate, because that's where the appreciation is, right? So money is constantly flowing from one asset class to another asset class. Can we discuss the predictors relationship for such a trend reversal? It's not a reversal, it's a natural process of evolution. Now what you do is you remain in the same asset class. So for instance, if you have invested in equities or in mutual funds, which is all part of the same asset class, you probably move your money from one mutual fund to another, or you will sell off the equities of one company and move into another. Highly unlikely that you will take a large chunk of money that you have invested in the equity stocks and go and buy a home. In terms of a sequence, you probably buy a home first and then start looking at equities. So there is a chronology with which individuals get into the various asset classes, provided they have a choice. Now this is another interesting question by Samiran. Currently we are witnessing a change from growth stock to value stock. Now, and he's talking about a 2-month period, October and November 2018. I presume you are reflecting on some of the things that have happened in the equity markets in this country, India. Now we need to look at it, understand this very carefully, because there is an embedded anomaly in your question. Let me try and clarify that. Value stocks, that means the equity stocks of companies which are well established, they are low risk, they pay high dividends, and their capital appreciation, that means the appreciation of the stock price, is not very good. Examples of this would be some very well established oil companies, an Exxon for example in the United States, or the Oil and Natural Gas Commission Limited, ONGC Limited, in a country like India. Now these are well established companies. Their expansion capabilities are fairly limited. They make huge profits, and what they do is they don't keep those profits. Most of those profits are pushed out as dividends. Now those are value stocks. Who would be excited about buying into value stocks? Pensioners, elderly, because they don't have a monthly income and they have to depend on the returns from their savings. So if you are a 60-year-old or a 70-year-old, and if you only invest in the equity stocks of companies, you are not going to invest in companies which are brand new or on the upswing. Those are growth stocks, and I'll come to that in just a couple of seconds. You would invest in value stocks where the dividends are high and you're not particularly concerned about appreciation of the stock price itself. In other words, you're not looking at capital gains. You're looking at cash flows every year on your investment to live your life month after month. Those are value stocks generally resorted to by the elderly and pensioners. Every country would have a whole host of value stocks. And countries would also have a growth stock. Now what's the growth stock? A company which is fairly young, nowhere near as old as an Exxon. It has growth opportunities, therefore its profits are not given away as dividends. Its profits are plowed back into the company as retained earnings so that they have more cash accruals to be able to make additional investments to expand their business. A good example of a lot of these are companies which were born in the last 20, 30 years. Google, for example, is one where they don't pay you dividends, but their share prices have gone through the roof because they plow back, they create value for the customer. That's reflected in the appreciating stock price, but they don't pay dividends. Now those are value stocks, right? Those are growth stocks. High growth potential, they are intrinsically more risky because they don't have the kind of track record that an Exxon has got. High capital appreciation, low dividends, and normally these stocks are pursued by aggressive investors, and by aggressive investors I mean persons who are younger, who want to create wealth for themselves and who are willing to take the risk. They're the guys who will go and invest in the growth stocks. Now, so there is, as I explained to you, a market for growth stocks and there is a market for value stocks. However, and that is the crux of your question, in times of high volatility, that means the stock markets are going topsy-turvy, all investors, almost all, would go to the safe haven, which is the value stock. They will ditch the growth stocks because intrinsically the growth stock prices are more volatile and the markets are going down, and therefore you don't want to be invested in them. You will sell out your growth stocks and go into value stocks. In other words, when the market becomes more risky, even the aggressive investor suddenly becomes risk averse and they move to the value stocks. That is what you witnessed in the Indian equity markets during October, November, because a large company called ILFS went berserk. It had a ripple effect in the markets, and there was a lot of bad news, and people said, hey, I don't want to be invested in a lot of these hunky-dory stocks. Let me move out and get into the safer stocks. So they would go into a lot of the companies which are what are classified as value stocks. That's a phenomenon we saw. With time, when the market volatility comes under control, and in all good equity markets that would happen with time, you will find that people get back, they sell their value stocks and go back into growth stocks. Now this movement is done not by individual investors, but hugely by mutual funds. Hugely by mutual funds. So if you're a fund manager of a mutual fund and you got $100 million kitty, people have subscribed $100 million into your mutual fund. In good times, that means when the economy is doing superbly well, you probably invested 70 out of those 100 million in growth stocks and 30 of the 100 million in value stocks. When the markets turn turtle, you just do it the other way. 70% value stocks, 30% growth stocks, or 60-40, whatever it might be. Now, when that kind of a churn happens in the market, you will find that it has an impact on the equity market index in that country. All right? So the drop or rise in the equity market index is an outcome stemming from the actions taken by the participants, the buyers and the sellers in that market. I hope I have explained the question in reasonable detail. Your next question is the relationship between treasury and stocks. I presume by treasury you mean bonds, corporate bonds, treasury bonds, and equity stocks. Now, that's a very interesting question because bonds are intrinsically, as I have said in some earlier webinars, intrinsically mean reverting. Now, if those of you who can recall the theory of bond pricing, when interest rates go up, bond prices will go down. And when interest rates go down, bond prices will go up. In other words, there is an inverse relationship. And please remember, interest rates don't go in one direction for too long. They would rise by 1 or 2%, then they will fall by 1 or 2%. So there is a certain equilibrium. It's like a sine wave, if you can recall your physics. It will go up and it will go down, it will go up and it will go down. Bond prices will do the exact opposite. When interest rates go up, bond prices will fall. When interest rates fall, bond prices will go up. So there's a kind of a phase difference in bond prices. The interesting thing therefore is you can make money. A bond with a face value of 100 might become 104 when interest rates fall. But when interest rates rise, it could probably go to 96. So your band for profits is $4 and your band for losses is also $4. It varies between 96 and 104. On the other hand, if you have invested in the equity stocks of a company that's doing well, year after year after year, the equity prices will only move northwards. In other words, increase in profits means higher retained earnings, which means higher net worth, which means higher book value, therefore higher market value of that stock. So well-performing stocks will always go northwards. Even the bonds issued by the same company would still follow the same sine wave, right? Now, why is there a relationship between bonds and stocks? The answer is very simple. If the markets, let's say you're running what is called a balanced fund. A balanced fund is what? You have invested in the treasury bonds or corporate bonds, and you've also invested in equity stocks. When the economy turns turtle, equity markets will take a beating, stock prices will fall, right? What is also happening is interest rates are rising at the same time. In fact, the stock markets are falling because the first thing that happens in any economy is interest rates rise. Now, the minute interest rates rise, bond prices are going to fall. If you think about it, it's a good time for you to get into the bond market, buy the bonds. So smart dealers will have 60% or 70% invested in equity stocks, 40% in bonds when the economy is doing well. But when it turns turtle, they will, in anticipation, when the stock markets are still high, they would go and sell off all those equity stocks at a profit, move into the bond market because interest rates have risen, bond prices have fallen, you'll be able to buy the bonds for cheap. When the economy turns for the better, interest rates will fall, bond prices will rise, you sell your bond portfolio at a profit and get into the equity market. So this is how balanced funds in the equity markets behave. In fact, if you're a shrewd investor in mutual funds, you must put some of your money in the balanced funds, as they are called worldwide, because it's an intrinsic hedge against turmoil in the markets. You either make your money in bonds or you make your money in equities. Important to be able to predict which way the markets are going to move and take the right investment decisions, which mutual fund managers can do a lot better than you and I as individuals. I hope that explains the relationship between treasury bonds or corporate bonds and equity stocks. Insight on the Federal Reserve's interest rates, Fed interest rate, which is the next question raised by Samiran Adhikari. There is something very interesting about the US dollar. It's a currency of international trade. It is the most widely traded currency today. The US economy is not the most healthy economy in the world, but the US currency is the healthiest currency in the world. So it's got nothing to do with the performance of the US economy. The rest of the world use dollars for international trade. So if Australia wants to buy crude oil from Saudi Arabia, it has to pay for it in dollars because the price is denominated in dollars. So there is a constant demand for US dollars, and therefore the supply of US dollars in the world, in fact in the rest of the world, is almost equal to, sometimes even greater than, the supply of US dollars in the US economy, because international trade is, as of today, denominated in US dollars. Now, what does this mean to us? Just think about it. Federal Reserve increases interest rates. Federal Reserve increases interest rates. I'll take India as a specific example to explain this. A lot of the money that is invested in our equity stock markets, we call them foreign portfolio investors, basically American funds which bring their money and invest it in the equity markets in India, Brazil, wherever else. Now, why did they bring it here? Because interest rates in the US are very low, whereas the returns they get by investing that money, in fact they can borrow in the US at 1%, bring it into a country like India or Brazil, earn a 10-12% return, adjusting for the exchange risk, they would still get a return of 4 to 5% net. The 6% reduction is because of currency fluctuations, which is good, because he borrowed at 1%, he was able to make net 4%. Now think about a situation where the United States says we're going to increase our interest rates. Immediately a lot of the money will flow from the other countries. US dollars invested in other countries will flow back into the United States because there's an interest rate advantage by going back into the United States. So the minute US interest rates rise, you will find a lot of the other currencies would fall in value, because in all of those countries the American investors have invested their money in the local currency. Now they're going to sell it, buy dollars and take it back to the United States. If they sell the local currency and buy dollars, the US dollar will appreciate, and everybody is going back to the United States because you get a higher return there. So any movement in the interest rates by the Federal Reserve of the United States, which is the monetary authority of the United States, will have ramifications across the world. It doesn't happen to any other currency, because most other currencies are limited to their own country of domicile. Whether you take the Thai baht, the Indian rupee, the Filipino peso, the Brazilian real, all of them, the currency circulation is limited to the country where they operate. US dollar is the most dominant currency for cross-border flow of funds, followed by the euro to a much, much lesser extent, Japanese yen maybe. These are the 3 or 4 currencies around the world that circulate outside of their own country of domicile. So the impact, any change in interest rates in those countries will have ramifications across currencies. I hope I've clarified that. The next is US-China tariff uncertainty on equity performance. Now, if you're not already familiar with this, there is an index called VIX, which measures the volatility of the equity stock markets. Remember, equity stock markets react to news flows. Every news flow that happens will have an impact on the equity markets at the macro level. In other words, all stocks listed in that exchange would move partially because of this news flow that impacts all of them. Now, that creates volatility, and that's why there is an index called the VIX. It measures the volatility of equity stocks. In order for me to explain this to you, let me take you to a couple of graphs. Here's one. Again, I've chosen an India example because I had to lay my hands on it at short notice. If you look at that graph, what it has, the blue line, is the VIX, the volatility index of the Indian equity markets. And the red line is the index itself, the Nifty, which is the index, the equivalent of FTSE or NYSE or Dow Jones. This is the Indian index, Nifty, CNX Nifty. Now, take a look very carefully at this. When the VIX, that means the volatility in the markets, have gone up, I hope all of you are able to see that, this space. What has happened to the equity stock prices? They have fallen. So there's an inverse relationship. The more the volatility in the markets, the more likely are the indices to fall. Right? They won't rise, they will fall. Now that's what you see in this graph. That's the reason why I picked it up. Here, if you notice, in this period, the volatility is very low, and as a result, the index has been able to rise. So in the first example, volatility was very high, so the index fell. That means the equity stock prices fell. On the other hand, when the volatilities were low, and the volatilities are caused by uncertainties in the macroeconomic environment. So when the VIX is low, that means macroeconomic uncertainties are very low, or even political uncertainties. You will find that the markets will move up if it's bad news, move down if it's bad news, or move up if it's good news. In other words, high VIX, adverse impact on the equity stock prices and the equity stock index. Low VIX, good news for the stock prices and the equity market index. So it's an inverse relationship. That's what I've tried to capture in that graph. Unfortunately, I got the data for the Nifty on this graph only up to 2016. And those of you who are familiar with the Indian market, of late we've had a turmoil, and you find that the VIX is going up. The markets are telling you that there is a lot of turmoil here. It's nowhere near as bad as it was a few years ago, but it seems to be inching up again. And you will find that as a result, the stock prices have been taking a beating. And those of you who are familiar with the market, you will know that the Nifty and the Sensex, which are the two indices in India, have been taking a beating in terms of the value of the index. Right. And I've got one more link to explain this. Which is more explaining how VIX is computed. I just said volatility index. Now the obvious question that may have come to your mind is, how do you calculate VIX? Now this article explains that to you. What is a volatility index? It's a contrarian sentiment indicator that helps to determine when there is too much optimism or too much fear in the market. When sentiments reach one extreme or the other, the market typically reverses course. That's exactly what I tried to explain to you. So how does it work? This is taken an example of the VIX computed by the Chicago Board Options Exchange. What goes into computing the VIX is the market price of the index. The index is taken as S&P 500. The prevailing interest rates. High interest rates means volatility. Low interest rates means low volatility. The number of days to expiration of the options series. Now, if you recall our lessons in options that we have done in the courses, in this course and in the earlier ones, if there's going to be good news going forward, you will find the options are trading at a discount or a premium, and that discount or premium is dependent on the sentiments in the market today about what the future holds. So an important input for the VIX is the futures and options prices that are being quoted in the market. Now obviously only highly developed markets have options and futures market, therefore the measure of VIX is more accurate in the more sophisticated financial markets. And this article goes on to explain what it is and why it matters, etc. You would have these links which I'll post on the discussion board, so you would be in a position to go and have a look at it yourself and learn more about some of these concepts, which incidentally would never be part of a regular course on equity stock markets. That's why we have this webinar, so you raise all of these questions. Now, Rashid from the Indian Institute of Science has raised a number of interesting questions. Again, like I did with some of the earlier participants, I'm going to go, I've split that into 2 or 3 questions, and I'll try and respond to each of them in detail. Which one is better, money market liquidity or stock exchange performance as the indicator of the economy? I hope the question is clear. It's a very interesting question. Money market liquidity, that means the short-term market, or stock exchange performance, which intrinsically implies the long term. Now, money market liquidity in well-run markets is usually a short-term issue. In fact, if the liquidity problem exists for a long time, then that economy is doomed. Because if you don't have liquidity, that means there is no money circulating in the system. Everything comes to a standstill. Probably this question, Rashid, stems from the recent issue we have had, where everybody is talking about liquidity crunch in the market. The manifestation of that, because liquidity has dried up in the system, stock prices will start to fall. That's a very natural outcome. Now, don't confuse issues there, because stock exchange performance is a robust indicator of the long-term economic performance of any country. It has some ramifications in the short term, but if you take an extended period, in well-run economies, the stock markets, the stock price performance would always be on the upswing. There may be temporary blips like that, but the trend will be northwards. And most commentators, and I hate to say this, most of them would be either the guys from the media who don't understand finance concept in detail, or the politicians who, I need say no more, they're the same in all countries. They're very evangelical, they're very persuasive, not always backed by sound theory. So they confuse between liquidity and stock performance. Now, a well-run company, it will encounter liquidity problems. It might have difficulty to borrow, but with time it will just ride it out. But if the company is fundamentally bad, that liquidity problem will never go away, and eventually the company has to shut down. Now, if there are several companies in the system which are not functioning well, and therefore they are not able to borrow, which means their stock prices will fall. So you can't have money market liquidity problem persisting forever. To explain this, again, I have a web link. Let's go into that. It's very simple. I've taken the NASDAQ, all right? And if you don't believe what I said, here is the graph of NASDAQ from about 1990 to 2018. Now, what this graph tells you is, if you had bought $458 worth of equity stocks back in 1990, $458 worth of equity stocks in 1990, and just sat on it, you did nothing. You didn't buy, you didn't sell, you just sat on it. It would have grown, this is good news, isn't it, to 6,527. That means it has grown by almost 15 times in the period from 1990 to 2018, a period of almost 28, 30 years. That's an equity stock. However, if you are an investor, you were celebrating and singing and dancing up to here, and then you went into a state of gloom because the markets crashed, but it picked up again. Now that's the resilience of equity stocks, and that's why I say stock market performance is an indicator for the long term. It is not an indicator for the short term. You will mistake it if you took this number for 5 days. You see this period, and you're going to go into a state of panic because the index was 6621 on the 21st of November and it crashed to 6525 2 or 3 days later. And then you're going to say, oh my God, the markets are tanking, there's a liquidity crisis. For goodness sake, this is completely misleading. If you're a day trader, you should be having advanced heart attack if this sort of a thing happens. But if you're an investor for the long term, remember the graph that matters to you is the long term. That's what measures equity stock performance. Liquidity is for the short term. In other words, there's not enough money available in the market. There could be a variety of reasons, but stock performance is for the long term. If you don't believe me, I'll take a completely different market now, right? This is the United States. This is NASDAQ. Here's another one, which is from a completely different geography. This is the Nifty, the India Stock Exchange Index. Now, take the max. Look at the shape of the curve. It looks exactly similar to the stocks listed in the NASDAQ. Between the period 1990 and 2018, if you had invested 890 rupees in the Indian equity market in the early 90s, it would have grown to 10,600 during the 30-year period. How much did you invest? 900, let's call it 1,000. How much is it worth today? 10,000. Your wealth has grown 10 times. That's a long-term story. But if you look at this tiny period from December 22nd to March 16, 2018, the markets have actually fallen. There might have been a liquidity crisis in that period. So if you are a media person, you're looking for sound bites, or you're a politician who wants to make political gains out of this drop, you're going to make a lot of noise, and that drowns out the long-term truth. So as an investor, that's what you should be interested in. Fundamentally, well-performing companies will make profits, they will pay dividends, they will be plowed back as retained earnings, the net worth is going up, the book value is going up, therefore the market price of the share should go up. And that's how it happens year after year after year after year. That's how your 1,000 rupee investment in 1990 is 10,000 rupees 30 years on. It's grown 10 times. The story was exactly similar for stocks listed in the NASDAQ. We saw that graph. So I would be uploading these web links for your reference. Do look them up, and if you have any questions, feel free to post them on the discussion board, and we love to give you the answers. And finally, experience tells us that a liquidity and stock market performance are correlated, particularly during times of financial stress. In other words, if you take a very short period, there's a liquidity problem, stock markets will fall. But if you get a long-term period, there can never be a liquidity problem in a country for a long term. If it is, that country is doomed. If it's well managed, the liquidity, one of the contributors to the growth in the stock market would be good management of liquidity. That's the role of the central bank in every country. Be it the Reserve Bank of India, be it the Reserve Bank of Australia, be it the Singapore Monetary Authority, be it the Federal Reserve, if there is a liquidity crisis in the market, they have the wherewithal to be able to come in and provide liquidity, unless the liquidity crisis is limited to one or two institutions. Remember in 2008, Lehman Brothers had a liquidity problem. They couldn't settle their dues. Eventually, they took a very tough decision to liquidate Lehman Brothers. a lot of the other institutions survived. Because once the rogue is moved out of the system and liquidity is pushed in, things begin to pick up. That is good monetary and fiscal management of an economy. Preference stock shell out dividends from profits after tax, which is a loss for the company. Due to issuance of preference stocks, overall PAT is reduced as compared to a purely debt portfolio. Now I want to clarify that. It's not a loss for the company, but a reduction in the profit after tax that should have gone to the equity shareholders, right? The beneficiary is also the government, because when you have preference shares, the same company with the same amount of revenues and profit before tax will end up paying more tax to the government. I've explained this very well with an example in a video, which is one of the early videos in this course called Equity Markets and Overview. It's in the very first week of this course. So please go and look up that video. Just to make life easy for you, I have actually pulled up that particular course, that particular video here. And I won't play the video, I'll just take you through the slides in that video that matter. I would urge it, when you look at that video, view it carefully from 9th minute through to finish. That's where I've explained this in its entirety. So here we go. Let me play this for you. I'll play it at high speed because we're not going to listen to the audio. I muted the audio. So let me take it right up there. Yeah. Let me go further up. I should have noted the point at which, yeah, here we go. Now, the original capital structure of this company was equity capital 500, debt capital 500. Now, what has the company done? Equity capital 500, preference shares 300, and debt capital 200. So they have altered the capital structure. So $300 million CCUs of debt capital is now converted to preference shares. So they issued preference shares, got the money, and reduced the debt capital. That's what they've done. So now what impact does this have? Let me go straight to that will come up just in a minute. Right. This is the one I was looking for. If you notice, the EBIT in both cases is identical. It's 200, it's 200. Now here, because the debt was 500 at 10% interest rate, the company had to pay 50 million CCUs interest at 10%. Now the debt is reduced to 200. So the company has to pay only 20 million CCUs to the debt holder. That means those who lent money to the company. So the profit before tax here is 150. It's 200 minus 50. Here it is 200 minus 20, which is 180. Now tax is 30%, 150, 1/3 is 45, and therefore profit after tax is 105. Now if you look at this side, the profit before tax is 180, 1/3 of that 54. So the government actually got, because of the change in the capital structure of the company, debt reduced, more preference shares, the government got 54 million CCU as tax, whereas earlier they were getting only 45 million CCU as tax. So the government got $9 million more. And the company has to now pay dividends to the preference shareholders, and that is 30, because remember it was 300 million CCU, so they had to pay 30 million CCU as preference share, as dividends to preference shareholders. The balance is therefore 126 minus 30, 96. So by simply changing the capital structure, by issuing preference shares and using it to pay off the debt, the company's PAT has come down, profit after tax has come down from 105 to 96. That means less money in the hands of the equity shareholders, because profit after tax belongs to the equity shareholders. The government, on the other hand, got that $9 extra. Earlier the company was paying 45, now they are paying 54. So by changing the capital structure, the company has actually reduced the PAT for the equity shareholders. The obvious question that will come to your mind is, what a dumb thing to do. That is probably the question that you are alluding to. Why did they do that? Well, they do it for the following reason. Maybe preference shares come at a lower cost. We don't know. In this case, I have assumed all of them to be equal. Or it could well be that the debt holders, that means the lenders, are knocking on the door and saying, please reduce your debt, we want our money back. If there was a situation like that, the company would go to friends and relatives, issue preference shares. This is particularly true of companies that are very closely held. Raise preference capital, normally pay a higher interest, higher dividend, assured, and they would use that to reduce the debt. And these are macroeconomic necessities for that company, because it's not, or it's got an expansion project. It's not able to borrow more. It needs the capital. Where would it go? Raise preference capital. So preference capital is a necessary evil, knowing full well that more the preference capital, more will the equity shareholders be hit, and more would be the benefit to the government. This is true virtually all over the world. So I hope with this example I have clarified that question. Feel absolutely free to go back and look at that video. If you have a doubt, post your query again on the discussion board. So it's not a loss for the company, but a reduction in the PAT. I hope I have explained that. That should go to the equity shareholders of the firm. Equity shareholders got less. The beneficiary is also the government, because they got more taxes. We saw from 45 it went up to 54, and that's what I've said. I've explained it in that video. So do feel free to go back, take a look at it, and write to us if you have any questions. Luke has a very, very interesting question. I've heard that derivatives are destroying the American economy, stock exchanges, and the financial system. What are your thoughts? Hey, I could write a book on this, but I'll restrict myself to just 2 or 3 minutes. I've not said that in this slide, but I'm going to give you an example. Any of you Puritans are not going to like that example, but bear with me. The cardinal principle in life is too much of anything is bad. The same is true for the use of derivatives. You know where I learned this? When I was a student, I had a finance professor. Interestingly, he took us out for a drink. Drink means alcoholic drinks. And as students, it's very rare for profs to take us out for a drink. Now we understood the clandestine reason for this man doing that. He was teaching us derivatives. So he took us out to this pub. He let us drink. A good number of us, out of the group of 7 or 8 students, almost 4 or 5 of us, we were in our best behavior in front of the prof, so we didn't have more than 1 round. A couple of them just went overboard, and they just went berserk. In about an hour and a half, they didn't know what they were doing. That's what alcohol does to you. At the end of it, as we got back into the car and were driving back, he said, the 4 of you would make good derivative traders. You 2 guys who lost your balance, you will make very poor derivative traders. Now that's a lesson I learned. Derivatives are good. Actually you go to a doctor and you got a slight cardiac problem, the doctor is likely to tell you, have a whiskey and soda every night. If you have one, it's good for your system. If you're going to have 10 of them every night, it's bad for your system. Derivatives are exactly like that. Derivatives are wonderful to hedge against interest rate fluctuations, exchange rate fluctuations, and so on. But if you're a speculator and you're greedy and you start over leveraging in that market, you could be cleaned up. So don't blame derivatives, blame the guys who don't know how to use it. Not very different to the example of my professor that I gave you. By design, derivatives are a great way to hedge your risks. But when they are overused with the view to speculate and earn extraordinary profits, traders get greedy. The consequences can be catastrophic, as we have witnessed repeatedly in every financial market over the last several decades. So that's the answer to your question. Derivatives are destroying the economy. No, wrong. Overuse of derivatives by some traders in the treasuries of banks and other financial institutions have destroyed the financial system. Don't blame derivatives. Blame those greedy traders, right? And I believe this is the last question. Review the most key points in, oh no, last but one, there's one more. Review the most key points in estimating the price of equity stocks. Now again, this is a subject which is taught very extensively, and there are textbooks on this in corporate finance and corporate valuation, where they discuss the theories and practices governing valuation of stocks. Now, this is not a course where we would do that in great detail. However, let me go through them very quickly. Your equity stock price is, if you can recall the concepts of time value of money, is the present value of all the future cash flows of this company. So, if a company, for example, is very convinced that it has an order book, that means it can deliver goods worth $100 million, $120 million, $150 million going forward 3 years, its cash flows are increasing, and as a result, the stock price would increase. Now, put very simply, if you're going to invest in this company, in the equity stocks of this company, you're going to say, wow, this company's sales is going up, therefore its profits are going up, therefore its retained earnings will go up, therefore the net worth of the company would go up. And today itself, the markets are discounting that good news and the stock price has gone up. Now, the better the future cash flows, the higher will be the stock price. This is the first principle. It's called valuing a stock using discounted cash flows. This is first principles in finance. And it uses the concept of time value of money, which we have learned in other courses. The second is the price to earnings ratio. Now, let's say the equity price is 100. Last year's profit was, equity price per share is 100. Earnings per share was 10. The price to earnings ratio is 10 because it's 100 divided by 10. Now, if the stock price, the markets are over exuberant about this company. Stock price went up to 150, but the earnings per share went up from $10 to $12.5 only. So the new price to earnings ratio is 150 divided by 12.5. Last year it was 10. This year is going to be 150 divided by 12.5. In other words, what this ratio is telling you is, if earnings per share is going up, then the price can go up proportionately. And this is called the PE ratio. The PE ratio of well-performing companies is almost always a constant. Prices go up because earnings are going up. If prices are going up faster than earnings, then that stock is overpriced because the markets are too enthusiastic about that stock. So if the price earnings ratio goes to 20, 25, 30, you would do well not to buy into that stock because it is overvalued. On the other hand, if you've got another company whose price to earnings ratio historically is, or even looking forward, is 8, please go and buy it because there's potential for this stock price to go up as the company's earnings are going to go up. People are going to recognize, here's a good company whose profits are going up, let's start buying that stock. When they start buying that stock, the equity stock prices would go up automatically. So that's price to earnings ratio. And its cousin is the price to book ratio. Book ratio is nothing but the net worth of the company divided by number of shares. Price is the equity price of that stock. In fact, the first two ratios is what is normally used by most equity traders to assess whether to buy that stock or not to buy that stock. In fact, in some of the videos in this course, I have alluded to this through some graphs and so on and so forth. You may do well to go back and look at those. And those of you who are interested in learning more, I've given you a couple of web links. Let me take you to them. And I'll upload this as well on the discussion board. This is a very comprehensive explanation of what is equity value, what is enterprise value, what is market value versus book value. It's a very interesting website in case you're interested in knowing more about the theory that differentiates all of these terms: price earnings ratio, discounted cash flows, and all of that. And there is one more, and these are available, they're just web links. They are available. You can go and take a look at them anytime. Market cap versus enterprise value. Are they same or are they different? With the insights that you've got by going through this course, if you go and look at some of these videos, and hopefully you've followed a lot of what I've said in this webinar, you will have a much better understanding of some of the concepts and the basis on which equity markets work. And that takes us to the very last slide. Share some of venture capital's great benefits. Now, venture capital, as you know, is a fund to which rich people contribute, and there are managers of that fund who invest it in startup companies, primarily startup company. That means companies that are very early in their existence. Now, what are the benefits of it? The venture capital fund provides equity capital, sometimes debt capital as well, to startup firms through one or more rounds of funding. So if I'm a venture capital firm, I've raised resources from filthily rich people and I'm going to invest it in a startup. I'm not going to give him all the money at one time. I'm going to tell him, okay, here's $1 million, take the business to the next level, then I'll bring in another $1 million, another $1 million. So that's what we call first round, second round, third round of funding. All funds are not made available right up front. As you grow, you get more. And as the venture capital fund manager, we also have expertise in taking to market the products and patents of the startup firm. A lot of the startups, they tend to be technologists who know how to build products. They know how to create IPs, but intellectual patents, but they don't know how to market it. That's where the venture capital firm comes in. And they bring in experts, they hire people on the marketing side of the firm, and so on and so forth, and help the startup to scale up its business and generate higher revenues and profits. Because remember, at the end of the day, you may have the greatest idea under the sun, product idea, but if you don't know how to take it to market, generate revenues and scale up your business, you're dead duck. So venture capital firms provide that infrastructure. And why are they doing that? Because they have an equity ownership of the firm, and if they make profits and their retained earnings go up, and therefore the value of the firm goes up, that means equity share prices go up, after a period of 5 or 6 years, they will sell those shares and make their money. That's the whole purpose of a venture capital firm. They are in it for the money, but what it does is provide a new vibrance in the startup ecosystem. Several countries around the world, venture capital funds have contributed to the growth of several companies. Go and look at all the companies that were born in the last 10, 15 years, be it Google, be it Cisco, be it Intel, be it Amazon, be it whoever, Flipkart in India. They were all funded by venture capital firms. The promoters had nowhere near the kind of wealth that was needed to build these companies, nor would banks or financial institutions give them a loan because they don't have a history. That's where venture capital firms come in and do a very good job. So that was the last question I had on the list of questions that you posted. Are there any questions that got posted in the? All right. So I ran the webinar for 1 hour. We started 15 minutes late. That's my fault. And we are ending 15 minutes late. In fact, to be precise, we are ending 3 minutes late, sorry. 8:45 to 9:48 according to the clock I have here, Indian Standard Time. So I hope that was useful. We will be uploading this on the course page, and I will post all these web links on the discussion board, so you can go and take a look at them, and if you have any questions, do write back to us. So if you have no questions, thank you very much, and we'll stay in touch on the discussion board, and all the best for the forthcoming graded quizzes and exams and all the rest of it. Good luck. Thank you. Good night.